Inflation is eating away at your savings. So we're going to have a look at why this is, share some shocking data on savings rates, and give you 4 ways to beat inflation in 2021.
Hi, I'm Simon Longfillet.
I'm Marcus De Silva.
And between us, we have worked in investments for over 30 years. And we're here to share some really simple secrets to investing that don't require much money. Knowing this stuff means you can earn really passive forms of income, and we focus on reducing the risks involved, so you won't be hearing any harebrained ideas on making a quick buck. Please like the video and subscribe to the channel. Don't forget to turn on notifications as we release new videos every Monday. Also, do leave a comment for us if you have any questions. If we don't know the answer, then we have a whole network of experts that can assist.
Today, we're going to have a look at inflation because it's rising. It has a big impact on your savings, and with low interest rates, it makes for a risky combination, much like children playing with scissors or flossing your teeth while singing or texting an ex following a 16 tequila shot marathon in Magaluf. We'll look at what it is, why it's impacting your savings, including some shocking revelations of the most popular savings accounts out there, and we're going to give you 4 really easy ideas for beating inflation using some simple stock market investments with some actual investment ideas that you might be able to buy. So stick around for those.
So let's start at the beginning. What is inflation? Inflation is the broad increase of the price of goods like Scotch eggs and services like pesky train tickets, for example. Every month, the Office for National Statistics takes a look at 180,000 prices across a basket of goods and services, covering around 700 items that we commonly buy at 140 locations across the country. And then they compare the prices to where they were exactly a year ago. The average across the whole basket gives us an idea of how much more expensive things are becoming. So, as we stand, the latest reading is a 2.5% rise in June 2021. So prices are on average 2.5% higher than they were a year ago, June 2020. Remember what you were doing in June 2020? No, I'd rather not either. But this will impact you because you will now need £102.50 to buy the same things that you bought a year ago for just £100.
Okay, so inflation is rising. Why is there this toxic mix with interest rates right now? Well, the interest rate that you receive on your savings is based on the base rate that the central bank set, the Bank of England. It's one of their main levers for controlling the economy. If your savings rates are lower than the rate of inflation, then you will be losing money over time. Now, we have some friends at Moneyfacts, a data provider for all things savings related. And unfortunately, they tell us some pretty sad and depressing things about the interest rates you are getting on your savings accounts. They've analysed all of them out there, and whether it's an easy access account, a notice account, a fixed rate bond, or any of the cash ISAs out there, none, yes none, beat the current rate of inflation. This is quite unusual actually. 1 year ago, there were 306 deals that beat inflation back then, and in June 2019, there were 126 deals. So you might ask, how much is this really affecting my savings? Well, the best instant access savings account is ICICI's at 0.5%, and the best instant access cash ISA is Marcus by Goldman Sachs, fantastic name, and they'll also give you 0.5%. So at 2.5% inflation, it means inflation is outpacing your interest by 2% each year. You're losing 2% each year. The good news is that important economic commentators, such as the Bank of England, are saying this issue that we're experiencing with inflation at the moment is transitory. It will go away because we're comparing prices to where they were a year ago when the world was in chaos with COVID, and that there's problems with supply chains, which is temporarily driving up prices as the economy wakes from its slumber. But there's the potential for it to become more permanent. The bank has also indicated that interest rates will stay low for a while. So this issue of low interest rates and higher inflation looks like it could stick about for a bit of time.
So how do you beat inflation? Well, the first thing is to clear your debt, especially the big ones, while interest rates are low. If you can't afford to do that, also look at consolidating debts into cheaper deals. Next, aside from an emergency fund of between 3 and 6 months of living costs, get those savings into the markets. You need to invest your money to stop it going backwards. Now, as soon as we say the word invest, people's heart rates shoot up because they think it's akin to buying Bitcoin or some other speculative thing, and they'll think they'll lose, 90% of their money overnight. For what we're suggesting, which is investments in diversified funds, that is incredibly unlikely. In fact, the boffins at AJ Bell, they are the third largest investment platform in the UK with 350,000 customers, gave us some insight into fund performance for the first half of this year. The worst of thousands of funds over 6 months lost 33%. The best was roughly the same, but in gains. So why does this diversification protect you? Well, it's because having lots of investments within a fund cushions you in the event that some businesses go haywire and a few of them tank. In addition, you can invest in funds with a professional fund manager selecting stocks for the fund, which should further protect you against poor investment performance because they should be selecting good investments. It doesn't always happen, but that's basically the idea.
So you might be wondering whether all investments do well in a higher inflation environment. The answer is no, they don't. Some assets, that's the things that the fund is buying, will do better than others when inflation is high. So we're going to have a look at some of those assets that do a bit better. We're going to mention some funds that professional fund selectors have said they like. These are not a recommendation, it's just for some ideas. We also don't earn any money to talk about them. Let us know if these suggestions are useful.
Okay, so idea number one. Generally, when you look at the two main asset classes, that just means groups of similar investments, stock market investments in company shares are a better place to be when inflation is higher relative to the other main asset class, bonds. Why? Because most bonds pay a fixed rate of interest each year, whereas income from company shares, known as dividends, can rise or fall depending on what the board decides. If a company's costs are going up, so things like its raw material or wages, then it could raise the prices of its goods or services and therefore its profits, and then pass on those rises to shareholders in the form of a higher dividend. Not all companies will pay dividends. The ones that do tend to be larger and more mature over, say, smaller companies or growth companies. We like investment trusts to access dividend-paying companies. This is because they have a revenue reserve, which is a pot where dividends can be stored when the good years roll and when they're plentiful, so that when things are less good, an investment trust board can dip into them and continue to grow the income the trusts pay out and continue to beat inflation. The industry body for investment trusts, called the Association of Investment Companies, or AIC, has a page dedicated to trusts they call dividend heroes that have consistently grown their income for more than 20 years. 17 of the 18 dividend heroes have delivered income ahead of CPI for more than 5 years. Check it out. Two trusts that are on that list are the City of London Investment Trust and Standard Aberdeen Equity Income Trust. If you want to know more about shares and bonds, stick around to the end. We've got a video for each.
Number 2, bonds. Now I know we said don't look at bonds, but some of you might want them. Maybe you're a little bit risk averse and you want something that's less risky than shares, or you might have goals that you're trying to reach that are less than 5 years. Remember, 5 years is really the minimum time you need for investing in shares. So there are some options if you want to still invest in bonds. One idea could be to go for these things called Treasury Inflation Protected Security, or TIPS. I mean, this is what they call snazzy naming conventions in finance. These are US government bonds that pay out a rate of interest that's been linked to CPI, a measure of inflation, so it should stay ahead. One fund to access these is Lixor's US TIPS sterling hedged ETF. Now, alternatively, you could go for a strategic bond fund, which invests in bond markets all over the world and in all parts of the market to try and find levels of income that should hopefully beat inflation. We might suggest Allianz Strategic Bond as an example.
Number 3, gold. Well, why? Simply because it's the classic asset investors flock to during periods of high inflation, and history tells us its value always holds up pretty well, but that's just what history tells us, so it's not a guarantee for the future. You might look at 91 Global Gold as an example fund.
Number 4, commodities. Things like raw materials and agricultural products also tend to be quite good as their prices tend to rise in lockstep with inflation. It's also a good time to invest in commodities in general, as quite a few market commentators are saying we're in the midst of a commodities super cycle, which really just means an extended period of demand for the commodities and rising prices. One possibility is BlackRock World Mining Investment Trust as a proxy for commodities through the companies that are extracting them out of the ground.
Okay, our bonus idea, and one for the die-hard fans, not the fans of the film, but more investing fans, a final idea for them. Infrastructure is also quite good at beating inflation. This is stuff like roads, bridges, water pipes, sewage, any infrastructure we see around us. And it's attractive because infrastructure contracts are generally linked to inflation, and globally because governments are about to spend loads of money on infrastructure projects, having neglected it really for many years. President Biden alone is likely to spend over $1 trillion on this kind of stuff. One example is the M&G Global Listed Infrastructure Fund, which invests in global companies that own or operate infrastructure assets.
Okay, to summarize, number 1, inflation is the general rise of prices. Number 2, it erodes the value of our savings if interest rates are below it, which they are. Number 3, we can invest in diversified funds to get round inflation. Number 4, the key areas to look for within these diversified funds are dividend-paying stocks, bonds that adjust with inflation, a strategic bond fund, gold, commodities, and infrastructure. We hope you enjoyed the video. Don't forget, we have a brand new free digital magazine. The link is in the bio, and within that there's loads of ideas of investments that beat inflation, plus lots of explanations about what's going on in the global economy. So please give it a read and share it. Thanks for joining us. We'll see you next time.
Goodbye.